Hey guys, welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And with us today, we have a very special guest, Eric Auslander. Eric, welcome to the pod.
Thank you. Appreciate the opportunity on joining the podcast.
Excellent, excellent. Well, before we dive into the details of your property, Sherwood Townhomes, it's a 24-unit multifamily in Charlotte, North Carolina. Talk to us a little bit about yourself, your background, and where you are in the multifamily space.
Sure. So I recently started up my own real estate investment firm in August 2022, focused on real estate syndications as well as joint venture partnerships. I do have some background in real estate. Prior to launching my own firm, I worked with Morgan Properties. They're the third largest owner in the country. And I worked in like an acquisitions role. So I was part of acquiring over 65,000 units with them and really getting them up to their, top 5 ownership status. So learned a lot from them, especially, how to underwrite, how to find deals. And now I'm using that knowledge to kind of do it on my own as well.
That's amazing. Yeah. Taking your skill set and building your own wealth and empire. I love it. So let's dive into the details. Okay. So we got Sherwood Terrace. It's a 24-unit multifamily in Charlotte, North Carolina. You actually mentioned it's in a suburb of North Carolina, correct?
Yes, it is. It's in Kannapolis, which is about 20 to 25 minutes north of Charlotte, off of Interstate 85. And,
Okay.
nice growing little suburbs. Got some little downtown vibe. A lot of development going on, and off the I-85 corridor, a lot of new businesses sprouting up as well.
Oh, that sounds like an amazing market. So when did you first acquire this property? What was the date that you closed? And then let's start diving into details on how you found it. Did you use a broker? Was it off market? Give us some insight there.
Sure. So we closed on November 1st, and we found it on a LinkedIn post, actually. And it was quote unquote off market, but it was like an off market broker. We had connected in the past while I was at Morgan. We had never done a transaction, but I saw this post and I was like, hey, this is like a perfect deal for me to get started in my own platform. 24 units. It's not like I have to go, tackle a 200 unit, complex as my first deal. And for the price that that was floated out there, it seemed to make sense. I say like 9 out of 10 deals that I find that are like the off market that are, kind of being shopped quietly by some local or national brokers. Typically, the price that either the seller or the broker is indicating doesn't make a lot of sense. So you kind of got to review a lot of these, and this one made sense to me, and I put my best effort forward to try to acquire it.
So talk to us like what kind of class of property it is, what vintage, what potential did you see in this property? What was your initial thought on the overarching business plan? And then when did you decide to pull the trigger and how did you structure your offer?
Sure. So I'd say the class of the property is B or C, depending on how you qualify that. 3 of the buildings were built in 1971, and the 4th building was built in 1981. Mix of like interior renovations. I'd say about half of it has some upgrades, and half are quote unquote classic units. Potential for the property, it's in a really good submarket. The median household income in this area is about $80,000. So you have the potential to really kind of bring it up. I like to say it's kind of like the worst asset in like a really good location, if that makes sense. So it's worth, putting some money into as part of your business plan. I guess my vision for this property is a mix of both an exterior renovation as well as correcting some curb appeal / deferred maintenance. So for example, we plan to paint all of the exterior, add some decorative shutters, as well as some metal awnings over the doors, to give it a nice little pop, as well as seal the parking lot. And in terms of interiors, we're gonna go on turn, renovate the units, stone countertops, stainless steel appliances, the washers and dryers, um, and just generate some more, demand for these type of units in this market.
Is there a gap in the rent? Were you seeing that the units were below market rent? And if you did an interior renovation, you can move into market rent? Is that what you were seeing?
Yeah, I saw a gap in terms of their rent roll. There was a lot of, I'd say over half of the units, tenants were there for at least 5 years.
Mm.
So they were getting some renewals, and then some of the new leases that that the seller had were, at $1,250 a month, and some of the older tenants were $800 a month, right? So there was like proven kind of like rent growth just in the rent roll. But in addition to that, I think the market supports $1,300 rents to $1,400 rents, especially with a renovation.
Hmm. Well, let's talk about. So you closed in August. When did you actually lay eyes on the property and decide, hey, this is something we want to put an offer in on? And then how did you structure your offer?
Yeah, so quick correction, close in November.
November.
Uh,
Sorry about that.
August is when I kind of launched and went out on my own. This opportunity kind of came across my desk, probably like within a week of me starting, and went full steam ahead. Went and toured the asset when we had some sort of like soft agreement on terms in terms of price. I think they originally were looking for like $2.6 million. I originally came in at like 2.5. We slowly worked up to about 2.55 million. Um, and once we had some sort of soft terms, then I went down there to get eyes on the asset, make sure what my vision was for the property fit. Actually seeing the market, seeing the rent comps, seeing the sales comps, and having some more conviction about where we could take this property to. So after that, we structured a purchase sale agreement and went forward with the asset. I was able to structure seller financing here at about 80% of the purchase price, which was perfect. Same thing for the first time deal because it removed some of my obstacles in getting a traditional loan, or even having to partner somebody to do a key principal and qualify for a bigger loan.
Okay. So what were the terms of your loan? Like, what did you do there? Like,
Yes, sure. So it was
number of days due diligence, closing, did you have to put any money down? When did it go hard?
yeah, definitely. So we put down probably, I guess, $40,000 for the deposit. We had I want to say a 30-day DD, and then like a 25-day closing, which we were able to work within that timeline. Um, the loan was structured as a 5-year loan, full term interest only, fixed rate at 6%. What I really liked about it is we structured it that it's prepayable at any time at par. So once we finish our business plan in a year or two, we can go target a refinance, deliver capital investors, and secure, in theory, a fixed rate financing, especially if rates fall back down towards the sub 5% range. Whitney, you're on mute right now.
Sorry about that. Did you initially pitch that seller financing, or was that something that you guys decided to bring later in during the negotiation process?
Yeah, so that was one of the first things that I threw out while I was bidding on the asset, and we were, structuring a price that worked for both the buyer and the seller. And it seemed like the gap between, the free and clear price and a seller financing price was minimal. It was almost the same. So it seemed very accretive to me to kind of try to go take this down and structure the seller financing.
Okay, awesome. So how many times did you have to go back and forth in the offer structure in order to get an accepted offer? And were there any other buyers looking at this property?
I'd say we probably went back and forth probably 3 times until we got a price that worked and we agreed on. Um, I believe there were some other buyers before me, that either put it under contract, um, and dropped it. I don't know the full story there, but, I know other buyers had looked at this. There was some deferred maintenance at this site, uh, including, like, concrete patios that were deteriorating, um, some, soil erosion issues, and these are things that we addressed in our capital plan and are budgeted for to fix. I will say, like, a project like this, it was perfect for me as a first time operator. Whereas, like, if I had 10 different assets that I was operating, I wouldn't even be looking at this just because of the time requirement on my side wouldn't make sense, right? So it's perfect for somebody like me where I can focus on it. And that's why, it was a perfect deal for me. So, yeah.
That's awesome. Well, I want to get into the lending and how you took it down, but before we do that, you've already kind of opened up the door on the due diligence. What did that look like? What was your timelines?
Yep.
And then also, walk us through, did you walk every unit? Did you uncover anything? What were maybe some surprises that you had?
Yeah, sure. So our timeline was about a 30-day due diligence. During that timeline, I vetted third-party managers within this market, interviewed about 6 different third-party managers, selected a third-party manager that I felt really comfortable, and really agreed with my business plan and vision. And they were a local third-party manager. They managed 800 units in the Charlotte market, and they kind of focused on the sub 100 unit management range, which is a perfect fit for this. In addition to that, we walked the site with 3 different contractors to get competitive bids to do all the deferred maintenance, exterior renovation projects, as well as some interior renovation bids. So we felt comfortable working within our initial capital budget. We walked, I want to say 75% of the units. There was a handful of units that we couldn't get into just because the door was locked and the tenant wasn't there. But after seeing 75% of the units, we had a really good comfort level with the level of interior renovations, both on what's been upgraded as well as what's a quote unquote classic unit. I guess in addition to that, what we found, there was nothing that really rubbed us the wrong way in terms of what we found. I will say that there was a growing water expense that was happening, and it was coming through on the financials over like a 3-month period, most likely due to leaks. So what we did is we structured an agreement with the seller, that if the water usage was over a certain amount, we would get reimbursed for the usage, if that makes sense. And the only reason that it really works is because it's a seller finance deal, right? If this was a traditional loan, like, the seller wouldn't want to be, paying us money back, right, on a monthly basis. So we are, and we found some leaks and we've corrected them along the way. In addition to that, we're installing water submeters, so that we can pass through reimbursements to tenants, as well as target any leaks or any overzealous tenants that like to take 2-hour showers or something like that.
I'm sure that is an issue that you have to look at, right?
Yeah.
Um, so that's the physical due diligence. With an older building, was there anything that was surprising on the insurance due diligence at all?
Sure. So yeah, there was a couple things here. So, like, there was older Zinsco electric panels on 2 of the buildings. So this is something that we allocated for in our capital budget. They're actually getting replaced right now as we speak. So that's something that is more competitive to the insurance industry, where you have updated electrical panels. But outside of that, we, in addition to walking to the site with the 3 contractors, we also hired PCA and phase one environmental slash property condition engineers to go provide an independent study on their findings, so we could compare and make sure that, outside of what we thought, as well as our contractors, that we were quote unquote checking the box. And that's something that's more typical with like a conventional loan, like a Freddie or a Fannie. But in this case, it wasn't required because it's a seller finance, but we still wanted to do that extra level of due diligence.
I mean, nothing worse than not doing it and then getting stuck later on whenever you can't sell it. So
Exactly.
all right. So let's turn to the financial due diligence here. What kind of information did you get from the seller? I would imagine with the seller finance deal that they were a little bit more open with providing financials. Were there any surprises? And then how did you firm up that construction budget? And how were you confident that you could execute that business plan?
Sure. So we received rent roll, financials, tax bill, insurance, loss runs. We did a lease audit, so we went and reviewed every single lease and make sure the terms matched the rent roll as well as the tenant ledgers. We reviewed all the water bills to make sure it wasn't allocated to a certain water account where the leak was happening. We actually discovered one water bill was actually a neighbor's water bill, so that was interesting.
Tell me more about that.
Yeah, there was just we were looking at the water bill and one account wasn't even related to the property, so it corrected itself through attrition, but it was something that we looked out for, especially when we took over. If we were going to get this bill, we obviously weren't going to pay that, but that was minimal. And remind me the second half of your question here.
Well, yeah. So, I mean, there was a level of construction and renovation that you were going to do on this property. How did you brought in, 3 different contractors, you did your phase one. How did you put together that budget and become very comfortable with the numbers and that they worked in your financial modeling?
Yep. So when I started the process, I assigned or call it allocated a certain per unit for both interior and exterior renovations. On the exterior, we were targeting about a $10,000 per unit exterior / deferred maintenance allocation, which at 24 units, that's $240,000. And then we add on some contingency as well. So it's just rounded up to like $250,000. So that was kind of like what I had in mind on, this is what I'm willing to spend. If we're going to come in substantially higher than that, that's obviously, material to the structure of the deal, as well as projected returns to investors. So that was the number I was looking at working within. And between walking the units and the exterior with the 3 different contractors, we were able to come up with a competitive capital budget that worked within that landscape, as well as some room, because there's things that pop up along the way. Like right now, we're replacing these electrical panels, and there's some conduits behind the panels that also need to be replaced that are going to, run an extra, $500 per unit or something like that. So you got to have
What was your cost overrun that you included? Was it like 10%, 15%?
Yeah, we included a 10% contingency on the 10,000 per unit. So call it 11,000 per unit. But, when we finalized our capital budget, we weren't, all the way up against the initial 10,000 per unit anyways. So there was some built-in threshold of contingencies there as well.
Awesome. Well, let's shift to the financing. Okay, so seller financing. What did you do to make these terms really appealing to the seller? I mean, how did you even broach that conversation? And then, backtrack a little bit, catch us back up on where the rate and the terms and what your exit strategy is on that, because that was a few minutes ago when we discussed that. And let's start there.
Sure. Yeah. So rate and terms, it's a 6% fixed rate, full term, interest only deal, fully prepayable at par at any time for a refinance. In terms of how we structured that, and it was kind of hand in hand with coming up with our offer. We originally, I think, proposed a 5% fixed rate, and as we were negotiating between price, and rate, because those are both, very sensitive to the returns of the deal. We were able to, structure a price that made sense with us, as well as a rate that made sense to the seller. Um, you know,
Any sort of penalties for selling early or refinancing early?
no penalties, and that's why it really worked, for us. In theory, we could go refinance today, right? Especially rates and treasuries are coming down. 10-year treasuries at 3.5 or below that. Um, and I've gotten quotes at low fives fixed rate on another deal that I have in the contract. Um, so I mean, there's that opportunity that we could go arbitrage it right now and bring that 6% down to a 5% or 5.25. But really, I want to execute the full business plan,
Mhm.
um, boost NOI, and then go target a refinance.
That sounds smart. That sounds smart. All right. So let's talk about the capital piece. So, walk us through the different layers of the capital stack here. Like, how much did the seller come in at for the seller financing? How much did you buy it in partnership with anybody?
So I am the main sponsor, on this opportunity. Um, so I didn't partner with anyone else to, um, be the operator, if that makes sense. The seller provided a note at 80% of the purchase price. But
Mhm.
once we add in our capital budget, it turned out to be about 65% of the loan to cost. Um, so the full equity raise here, or the equity that we closed with, was about 1.2 million.
Mhm.
Uh, and in that, since this was a first deal for me, I thought it was important to, have some skin in the game. So I invested 10% of the equity, and the remaining 90% we did sort of like a friends and family, as well as some accredited investors to, um, go raise the other basically $1 million.
So you worked with the accredited investors only, or do you have sophisticated investors in the deal?
Yeah, this one is sophisticated investors, which is the 506B.
Mhm.
So we didn't only allow accredited investors. We worked with investors that, I had a close relationship with, that I know that are sophisticated.
Mhm.
Um, and then in terms of structure that we ran here, it was a 8% preferred return. So investors get 100% of all cash flow up until we deliver that 8, and then, a 30% of the sponsor over an 8, and then once we deliver an 18, then a 50-50.
Okay. So, and are you doing a return of capital or return on capital model?
I'm not sure what the difference is between those two, but whatever capital was invested day one, that accrues yearly at 8% or 18%. Um, And as we distribute and return capital investors, that obviously pays down those accrual balances,
Okay.
if that
Awesome.
answers your question.
Yes, it does.
Okay.
And then so you're the sole sponsor. So the any additional split would be go to you, or do you have to share that? Did you bring on any sort of key partner or anything like that for the loan?
No, no sort of key partner on this one. The deal that I currently have under contract in Raleigh, that's one that I would be working with another, key principal, something like that. So
Okay. And then how did you structure the fees for this deal?
sure. So we did a 3% acquisition fee, mostly because it's a super, tiny deal. In addition to that, we did a 2% asset management fee just on revenue, not on equity. And then a 6% construction management fee, to oversee the renovations and make sure everything gets done in a fashion and timely matter here. Other than that, there's no other fees. There's no like guarantor fee. There's no refinance or disposition fee. I wanted to make my incentives in line with my investors as much as possible, and deliver those projected returns without me skimming off the top of a refi or disposition. So.
Awesome. Well, let's wrap up a little bit here. I mean, because this is an amazing, sounds like a great first deal, especially, launching your company in August and this coming across your desk 1 week later. How fortuitous. But
I thought it was like too good to be true. When I went on my own, I kind of gave myself like a year to get one deal done, and it was like a weekend, and I like have something under contract, and I was like, is this is this real? But it turned out, and we got it done. So I was really happy with it.
Well, I mean, obviously you brought in a lot of knowledge and skills already, right? You didn't have to go learn all that like in that first year. And it sounded like this was you pulled in or tapped into a relationship that you'd already developed. So that's amazing.
Yeah, and I won't say that it was like you necessarily need that, right? I think the biggest shift for me and the mindset change is more so like becoming a full-time entrepreneur, which is different than being a salaried W-2 employee. Comes with its own competitive challenges as well as level of stress, right? So that's been more so like the learning experience for me. Uh, as well as being a full-time operator, right? Because where I was at before, I was more so on the acquisition side. We would have a layer of like reviewing the performance of the deal on a quarterly basis. But in terms of like being involved with the day to day, that's something that I'm learning and growing my knowledge and skill set incredibly over time.
That's awesome. All right. Well, I have a couple more questions for you. And
Sure.
I would love you to kind of think back as you went through this process. Were there any other issues that cropped up that we haven't talked about? And what went hard? What was an obstacle? Or was there something that was easy that you thought was going to be more challenging? And was there something that you thought would be more challenging that actually was easy?
Hmm. I will say that what I thought was hard that went easy was actually for this one was raising the equity. I had never done that before. Where I was at before with Morgan, we would do joint venture partnerships with institutional capital partners. So we would bring in one partner to do a deal. Whereas here, I had 24 investors in this deal, and it went really quick. And I was fortunate with that. What was hard that I thought was easy, uh, I guess was really working with like a vetting and finding a third party management company that I really bought into. When you're looking at the 200 unit plus stuff, everyone kind of operates the same way. It's they have a certain management fee, uh, and it comes down to a lot of these folks are managing 20,000 plus units across the country. They have it down to a science, right? But when you're looking at these 20 to 50 or even 75 unit deals, every third party manager has its different structure. And on top of that, they have a different way of working with the asset as well as the owner. So that was, a challenging piece for me is it's just kind of learning that process and really trying to find one that worked with my mindset and business plan because, they're the ones that are doing the day to day leasing and if a toilet's leaking, they're figuring that out. So
That it sounds like I mean, I initially cut my teeth on single family rentals, and it sounds like a similar problem there, right? You can have your professional management companies and you're a number, or you can have the more, high touch relationship with the property manager, and you're just like, you're trying to figure out like where the quality comes in, right?
exactly, and it's like ultimately it comes down to a numbers game, right? Where it's like, well, do you sacrifice management fee and pay a little bit higher, but get a better, in theory, like quality of manager that's going to boost rents and keep expenses lower, your other expenses, or do you, go for the cheapest management fee in the game, but in theory you could run, there could be tenants that are applying and that management fee company or management company just not even calling back those prospects and your property is slowly deteriorating in occupancy. So
Mhm.
um, it's kind of like a balancing act, and some of it you don't really know until you're running it with it. So, but I've been fortunate so far, and I appreciate the management company here. It's AM Realty, by the way, out of Charlotte. So I'll give them a shout out.
There you go. There you go. Well, Eric, thank you so much for sharing your experience with us and your knowledge today. If listeners wanted to find out more about you, where can they find you and follow you?
Yeah, sure. So I am on LinkedIn, Eric Auslander. I have a website. It's called Auslander Capital. Um, And the name of my firm is Auslander Capital Partners. I'm also on Facebook and Instagram, and yeah, I think that's probably the best ways to kind of follow me and see what I'm doing. I'm pretty available. If somebody wants to reach out to me, I'm pretty responsive. So
Fantastic, fantastic. Well, Eric, thank you for being with us here today. We look forward to following you and having you back on the show to cover a future deal.
yeah, Whitney, I appreciate being on as well. As we said before, this was kind of my first time doing a podcast, so it was really interesting to me. And thank you for having me. I really appreciate it.
Absolutely.